Jonathan Davis is the economist and wealth manager that we regularly have here on the station. He's an outstanding analyst and a very good talker, and I'm glad to welcome him. Jonathan, welcome to the show.
Thanks, George.
Explain to us what's happened with the fabled, famous Deutsche Bank.
The same that has happened to every major and indeed minor bank across the world over the last 10 years. They've got to the stage where they have so many potentially bad trades in their accounts that eventually, when one of them blows up, it blows up the whole system. The whole banking system is a massive spider's web integrated globally. A piece of history, you're talking about regulation which created 2008. I'd be interested to have a debate with you about that. But when you look back at 2008, it hit the mainstream media in September 2008 with Lehman's and AIG going bust, the biggest banking collapse in history. But 6 months before that, we had Bear Stearns in the United States, another huge investment bank, which wasn't in the mainstream media. It went bust, and the politicians and the central banks were able to paper over those cracks. Before that, a few months before that, in little United Kingdom, we had Northern Rock, which went bust. But before that, 6 months before, in early 2007, we actually had the first stage, the first step in the global banking crisis. And you know, it didn't start with some huge bank the size of Deutsche or even Lehman's. And by the way, Deutsche is 10 times the size of Lehman's. It didn't start in a major economy. It started in an economy which went bust. Its banking system went bust. It's a population of 300,000, the whole country. We're talking about Iceland. And it was the proverbial butterfly 8,000 miles away that flaps its wings. And in this case, a year and a half later, we had a Poseidon Adventure-sized tidal wave of banking collapses. And that's why I agree with you. In fact, that's what I told your producer earlier today when you invited me on. It's extremely unlikely that Deutsche will be let go bust. There are far too many powerful folk politically and financially who would have their shirts ripped off them if Deutsche went bust. But again, as I said to your producer, I think it's highly likely that over the next year or so, I mean, who can tell exactly, that there will be a little minnow bank somewhere, Portugal, Ireland, Italy, who knows, and it will be the proverbial butterfly. There's no question in my mind it's coming. The cracks in the system are widening as every single day.
Wonderful metaphors and a wonderful description for which I thank you. Let me press you on one or 2 points, if I may. One imagines, perhaps wrongly, tell us if I'm wrong, that the Germans were not quite so stupid in allowing banks to do exactly as they please in Germany as they were in the United States and in Britain. In other words, there would have been a more strict culture that the politicians would insist upon. That would appear not to be the case.
No, it's not the case. 2 points I'd like to make. One, in 2008-9, with the TARP facility in the United States, where basically they gave the banks $800 billion. I mean, it's so an unimaginable amount of money, but that's what they did. And in effect, they recapitalized the balance sheets of the banking system in the US. They didn't do it in Britain, and they haven't done it in the EU. And they're still doing it 25 years later since the initial crash in Japan in 1990. So in the US, actually, they created some relatively more health in the banking system than everywhere else. So that's the first point. The second point is the numbers are very interesting. The global economy is estimated to be around $50,000 billion per annum. The global GDP, 50 trillion. The amount of derivatives, financial derivatives in the global banking system, basically a bit like insurance contracts, is an astonishing $700,000 billion. $700 trillion, 14 times the size of the global economy. And Deutsche Bank, which to my mind is Germany, it's not the little manufacturers that make up, that all supply into Mercedes and VW Audi. That's what they want us to believe. Deutsche Bank is Germany. And Deutsche Bank's derivatives on its books are 10% of all of the global derivatives, $70 trillion, one financial institution. That's how ridiculous the Germans allowed Deutsche to get.
That is amazing, because you know much more about finance than me. I suspect I know at least as much about politics as you. And yet I would have imagined that the stolid, solid, Germanic and regimented, regulated way of doing things would have avoided that kind of exposure. Now, Deutsche Bank is too big to fail. I mean, if you're right and that Deutsche Bank is Germany, then clearly it will not be allowed to fail. Banks too big to fail, bankers too big to jail. We are familiar with that. What about lower down the batting order of German banks? Might one of these butterflies that flaps its wing be there rather than in Portugal or Ireland?
It could be. That level of detail I couldn't discuss, because it's not my what I know. It could be. I think it's unlikely that it will be in Germany that the Frischer takes place, like Bear Stearns, as I say, in February of 08, then Lehman's in September of 08. It's more likely, to my mind, to be in the smaller, less powerful economies, Italy, Portugal, Spain, Greece even, goodness knows, Ireland. The politicians and the central banks, the European Central Bank, the Federal Reserve, the Bank of England, the Bank of Japan, the Bank of China, you name it, the Bank of Uncle Tom Cobley, they are literally throwing money at the banks, because they know that if they let the thing bust, it will be even bigger than 2008, simply because the level of debt and derivatives, financial instruments, financial insurances in the system is a multiple of the size of where we were 8 years ago. Now, what I say to that is they should have sorted the problem out in 2008. They should have let the banks go down. They were reckless lenders, thus they should have been allowed to fail. That is capitalism. Those who say that we have a failure of capitalism either don't know what they're talking about or are being politically disingenuous. We don't have capitalism, because in capitalism, capitalism without bankruptcy is like Catholicism without hell. In other words, what we have is corporatism, cronyism, socialism, but it is not free market capitalism.
We'll have to debate that another night. But let me just ask you, or rather put this point to you. As you've described it, this is a high wire act that we are on. Mm-hmm. On a wire that is higher than the Empire State.
Oh,
And
yeah.
it sounds to me an extraordinarily unlikely event that we're going to get across that wire without falling off. These derivatives that you talk of,
Mm.
they constitute a kind of thermonuclear
Mm-hmm.
bomb sitting
Well,
there ready to explode.
Warren Buffett, arguably the greatest investor of all time, he calls derivatives weapons of mass financial destruction. And that's exactly what they are. And the system is meant to be that if one banking institution takes one side of the insurance and another bank takes the other side, well, therefore it's in equilibrium, it's in balance and not a problem. The problem is that the balances don't happen. And they paper over the cracks. In 2008, they put elastoplast on cancer. And they gave them painkillers. And of course, what they did was kick the can down the line. I've been saying this since 2008. And they've done a remarkably good job of kicking the can down the line. Because there has not been a political will to let the thing reset. And that's the great problem. Because the more you pull that elastic band, you can pull it and stretch it and stretch it and stretch it, and then stretch it some more. But eventually, it will snap back, and that is what is very likely to happen, I'm afraid to say.
Short of us all going to the southern tip of the South Island of New Zealand, what can the norm... I mean, there are 16 million people in Britain, I learned today, who have less than £100 in the bank. 16 million.
Yeah.
They've not got much to lose, many of them. But what do people who've got something to lose, perhaps a little bit of a bank balance, perhaps a little bit of a portfolio, perhaps a house, what can they do about the dangers they're now in?
Yeah. Well, there's a number of issues there. If it's relatively small bank deposits that they have, there is a taxpayer guarantee. The first 75,000 or 150,000 in any independent financial institution will be guaranteed. In Cyprus in 2013, you and your listeners will recall, there were bank deposit confiscations left, right and centre. Their banking system collapsed. They had bank bail-ins, and that was the template. We are very likely going to have bank bail-ins again, but it doesn't apply to Mr. and Mrs. Average. It applies to millionaires who've got an awful lot of cash. So if you don't have an awful lot of cash, up to say 900,000, well, you can split that between 6 banks. That's what you absolutely must do. If you've got more than 150k as a couple in a bank, you're mad. Put it into another bank until you get down to 150k maximum in any one bank. That's the first point. Second point, in your pension, in your stocks and shares ISAs, in your investment portfolio, as you say, there are two investments which for the medium term, to my mind, are going to secure the portfolio and probably grow the portfolio. One is, strange as it may seem, lend money to the US government, buy what's called US treasuries, government bonds. In a deflationary world, government bonds rise. And over the last 3 years, those treasuries, particularly in sterling, have gone up 30 or 40%. They may pull back a short while, but if we have a recession, which we're likely to have, they'll go up through the roof. The second investment to buy is gold. Gold is in a multi-decade bull market. 15 years ago, it was $250 an ounce. It's now $1,300 an ounce. It's volatile, no question, but buy gold, put it under, dig a hole and put it in your garden, or put it in a vault in Switzerland and forget about it. Those are the two things that portfolios need to do.
Well, I suspect that almost all of my listeners will be amongst the 16 million who've got less than £100 in the bank. But if there are any who have any of these things, you've definitely given them, I'm sure, sage advice. Jonathan Davis, economist and wealth manager, talking about Deutsche Bank and the coming crash.